Hey guys, welcome back to the Capital Mindset Show. Today we're going to be revisiting a stock that we covered way back when at the earliest days of this channel, and that is Disney stock. So Disney stock, we covered it as a subscriber request, and back then we barely got any subscriber requests, but the subscriber wasn't too happy at our analysis of Disney. So the analysis I put out on Disney was not too favorable, to say the least. And I'll actually showcase that. You have the stock price right in front of you now. It's about $130. Let's actually go over to the video. And yes, I did just like the video, by the way, so deal with it. So I self-liked the video. So September 24, 2021. And it's kind of, I liked it myself now because I said, it's basically a way of me telling my past self, you did good on this one. But this analysis was done on September 24th, 2021. And let's take a look at the price action around there. And it is down about 26.8%, 27%. So to speak, it has underperformed the market, the broader index, which actually was a statement we stated in that video on Disney. And it was based on the valuation that we will go over again today to see if anything has changed. Because as we've covered other stocks in the past, again, we have seen that the risk reward does change. For example, Stitch Fix. I think I was pretty objective in saying that, well, when I talked about it, it was 35 and it was unfavorable, or in the 30s, whatever it was. And now that it's hit the price targets where I thought, it could possibly get to, which was $11 a share. Now that it was there, obviously we have reached a de-risking moment in that particular stock. But looking at Disney, well, what's going on? Well, a lot of people who, I've spoken to about or regarding Disney were saying, okay, well, the parks are opening up, Disney stock must go up. And this is around there. So I think this was a stock that a lot of what I call, or what many call this, I think a proper or popular vernacular term to call someone a normie, depending on what you are interested in. But stock normies, people who just entered the market, were, very emphatic about Disney. And actually, my wife actually was a very good, I'm telling you, she does like really good moves. So she had bought Disney around here in the pandemic low. She got it for like $80. And she actually did, and I can swear by this, she did sell at 170 something dollars. She didn't sell at the very peak. I remember that it did go up, and she was like, I should have waited. But then it turns out, hindsight, it was a very good move. She realized that the exuberance was too great, and she started noticing a lot of people who were getting into the market. One of the stocks they were buying was Disney. So this exuberance led to an underperformance and actually stagnation over the course of nearly a year, right? So we saw this massive run up. We saw this Disney Plus run up, as we can call it. And since from December all the way to about, again, December, no movement whatsoever. And then all of a sudden, collapse. Or not collapse, but severe underperformance and now in negative territory. So quite concerning in terms of performance. If you're a bag holder in Disney, I feel sorry for you, because the rest of the market has gone up. So now we change our method of analysis and we go into seeing if today the story has changed. Okay? And that's what we're going to discuss. I want to take the time here to dispel a comment, right? Or a rumor, not a rumor, a misconception, I'd like to call it. And it's taking a look at this number. So if you Google Disney yearly content spend, you will get this number, $33 billion. Now, this is of the fiscal year 2022. So I want to dispel the notion that, the likes of Netflix, well, they don't have the content library. And this is a massive disadvantage because Disney doesn't have to spend as much on content because they have all this content. And everyone wants to see the old Mulan and not the new Mulan, or the old Beauty and the Beast and not the new Beauty and the Beast. Well, some of those things might be true, and there might be classics, known as classics. Consumers are consumers, and they want the next best thing. They want the new thing. They don't want to watch the same movie over and over and over again. So I think that this is a notion a lot of people repeat, and you see this on media, as in CNBC and all these other channels. You might see that they say that, and when you really break down that idea, it doesn't make too much sense, right? And we're kind of seeing it with the numbers. I'm trying to be objective here, and I have a counterpoint to my point, right? Because I will state, for example, this number, and I think it's a very good counterpoint because I'm debating almost with myself. And I think, by the way, that is a thing that when I was in high school, I competed in a debate, right? I was one of those nerds. And I'm also a Star Wars nerd, if for those of you who don't know. So I'm a little spiteful towards Disney, but I'm trying to remain, objective here. But regardless, so a good strategy to try to keep yourself unbiased is practicing the technique of debating with oneself. All right, so I'm going to try to attempt to do that here. But right now, a counterpoint to the point I just stated is that $33 billion is the entirety of the content spend, which includes movies. And remember that with Disney, when they sell those tickets, they recuperate a lot of those expenses that they expensed on that movie production, which Netflix does not do. All right, but we also have Warner Brothers Discovery, which also does that, and we have that as a standalone streaming company. So we have to be cognizant that Netflix is not the only competitor in town anymore. Well, HBO Max has been there, but now it's going to be a very serious, focused player, which I am watching. And by the way, I had that company designated to a sell, but I had since removed it from a sale, and I actually didn't really even get to sell any shares. I don't really like to make too many moves, but I changed it out from a sales and kind of kept it where it is. So we'll see what happens. But that's not the point. The point is for Disney, I want to dispel this notion that they don't need to spend that much on content. In fact, they still need to spend a ton on content, and that makes the valuation a little bit more difficult, just as we discussed in the Netflix video. So if you haven't seen that video, go check that one out. That is when I first talk about the difficulties of understanding and evaluating a company like Netflix. You have to look deeper than just the cash flows. You got to actually do some magic and figure some stuff out, and we'll see that with Disney as well. All right, so let's actually go over to the model and figure out what the heck is going on with Disney. And here's Cardinal Health, but we don't care about Cardinal Health. Let's go to Disney stock. Okay, so looking at Walt Disney, let's let everything load in. We're going to only look at the analysts, and we're going to end this video. So I can't even say that with a straight face. The analysts have this as a strong buy with a price target of $178.98, implying a 37.18% upside. Okay, so that's the analysts. If that's all you're here for, you can click off the video. If you want more, we're going to continue on and evaluate this ourselves. So I think I'm going to keep the discount rate at about 12%. I think for Disney, some of you might say that's a fair discount rate. And then I'm going to increase the discount rate later. Okay, so one thing I want to note is taking a look at the PE and the price to free cash flow. We see a company looks extremely overvalued. We're like, oh, 120, disgusting. All right. And then taking a look at the return on equity, return on invested capital, they look terrible. This company looks like it's a horrible company, right? But I'm told by everyone, this is Disney, right? The greatest company ever. Well, yes, it's because the GAAP numbers are reflecting something that is not the proper way of looking at it. Okay, so it is reflecting something that is momentary, something that won't occur forever. So we as investors have to kind of work around this fact, and I apologize for smacking the camera there, but we have to work around this fact and kind of adapt our analysis to that. Okay, so taking a look at the PE and the price of free cash flow, they seem very high, which is kind of a red flag saying, hey, you're analyzing me, please look at this, investigate this, because otherwise we're just going to assume that the market is completely lost its mind, right? That the market is, looking at a stock that doesn't really grow too much as far as the business goes in terms of revenue each and every year. It doesn't grow too much, and it's priced at a 77 PE in that instance for what Google's saying, or about 120 price free cash flow or PE of 120, right? Doesn't make too much sense. So what the heck is going on? We do see a sentiment score of 1, so retail investors probably really like this stock. But let us take a look at the data sort sheet, and we can kind of go through some of these numbers together. First, I want to highlight, take a look at that long-term debt. Long-term debt right here, right? We follow it to its conclusion, and we see that in 2019 it was $38 billion. 2021 is $51 billion. So some balance sheet destruction has occurred in order to save the company, so to speak. Okay, and this is hopefully a lesson you'll have learned from this channel, because I've repeated it so many times, and I will always repeat it for you guys. Something I learned when I had my tutoring business is I have the patience to repeat something infinitely if I think it is a valuable lesson. And that is, if a company is profitable, please do not think for a moment that they will not dilute you. Okay, the management team's job, and specifically the CFO and the controller and all of them, are to work together to find the cheapest cost of capital. And in some instances, that's debt. In some instances, that's issuing shares. And we'll actually get to that because they have diluted you a bit. All right, so taking a look at the cash flow statement, actually, I want to talk about the cash flows. Cash flows look fairly small at about $2 billion. But we know this from our Netflix video, and I know my loyal subscribers out there have seen my Netflix video, and you might be saying, well, Fabio, this company spends a lot on content, which is a cash expense that is similar to CapEx, but, right, Disney does have CapEx because Disney does have a lot of physical assets, but in content spend, that's like CapEx. And we can't punish a company for having growth CapEx. So we can't punish a company for having growth content spend, right? Growth content spend. We can't punish the company for that. So what are we going to do? Well, we got to figure out more or less what is the maintenance content spend, similar to similar to Netflix. And perhaps for these kinds of companies, it is better to understand it through the lens of GAAP net income, right? Because GAAP net income kind of is supposed to, right? GAAP net income is intended to kind of give the investor a glimpse of or a good understanding of what the business is doing. That's its intention. While I, on this channel, challenge everyone to think outside the box and sometimes say, well, sometimes it doesn't. Sometimes there's other ways of doing it. But in a lot of instances, yes, it does, okay? And in this instance, yes, it does. All right. And I think that's the objective. No, I'm kidding. That's not an objective truth, but you get my point. All right. So right up here, my eyes, I'm more or less used to this, so I can spot this immediately, but I'm going to walk you through basically how I would kind of go through this. So I'm here and I'm like, okay, well, what's going on? So I know that the nuance, I need to look at GAAP net income for this business. And I'm like, oh, okay, looking through this. Look at that. They have 11 billion and all of a sudden they're at 2 billion. Okay, so right there, boom, off the bat, I understand where my anomaly is. So there's something there that has changed, that has occurred, okay? So if you want to investigate, you just go up the line items and you kind of try to look for these anomalies. And you look, well, I have it easy because I boldened the numbers, but you go up to EBIT and then you try to see if is EBIT, off, and EBIT is off. So if EBIT is off, by you should be able to eyeball the difference, right? There is technically a way to use statistics to calculate if it's an outlier, but you should, for the most part, be able to eyeball the difference. And okay, right there, I see EBIT. There's a big difference. We went from 15 to 3, so that means the difference is above the line. Okay, so we go above that, and then we go to EBITDA. So EBITDA, we see the difference is again quite drastic, from 19.5 to 8.6. So now we know the difference is above that, and then boom, right there, we spot our first difference. So we see two differences here. See the difference in operating expenses, they increased, but also gross profit went down. So we had a double whammy, and then that's where our differences occur. So that's how you more or less would investigate that, and you would find the exact expenses that would be the change, but that's a quick example. All right, so taking a look over here, we're going to say, okay, we're going to use the non-profitability analysis, because it's much easier to use this one than the adjusted cash flow for this instance. And then we're going to give it the profitability metric of about 16%, which is about what it normally states. And year of profitability, we're going to assume it goes back to year 2. Let's go to the ratios to get an idea of what the heck's going on. So for blah, 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 blah. For anyone wondering where I got the 16% from, you can actually go here, and I actually just wanted to see what was kind of like the normal net profit margin, and we can see more recently it's like 16, sometimes 21, some 16. So I averaged it out as 16%. So I basically went back and said, okay, they're going to achieve 16%, and I assume that not this year, but next year it's going to get there, and so I priced it in that next year it's going to recover. All right, so back to the analysis. We're at a 12% discount rate. We can see that if we think it's going to grow at 15%, well, here we're in business, right? We can effectively buy this. I want to now talk about the share dilution because I did mention, and I don't want to forget to talk about that. Let's go down to the visualization. You see that nice chink up? Well, that chink up implies, or not implies, is showing us that dilution that occurred since about 2018. And again, it actually started in 2019. So fun fact, before the pandemic, Disney was already diluting you a bit, okay? So why would a company that is profitable be diluting its shareholders? It's almost as if Capital Mindset is trying to tell his audience, and talking in third person on purpose, is trying to tell his audience that there's an added nuance to understanding why a company does dilute, right? Simply beyond the fact what other people out here on the YouTube nether have stated, which is false, right? They stated blatantly false information and yet charge people for this information. Good thing it's free here. That you don't actually... You can't think of a company that way. A company's management team, depending on what stage they are in the business cycle, in terms of their life of the company, they're going to go for the cheapest cost of capital. They want to bring down that CAGR. That CAGR needs to come down, right? If you're a good management team, you got to bring down that CAGR. And how do you bring down that CAGR? Well, you use the lowest cost of capital. Sometimes it's going to be debt. Sometimes it's going to be shares. Here, it was shares, right? So they started before the pandemic, and then they continued after the pandemic. And ignore these years. These years are wrong. This actually should be the more recent year. But regardless, taking a look at back here, I'm not going to assume any share dilution. We're not going to assume that. We're going to assume 0. We're going to assume that, okay, they don't need to do it anymore, and we're going to be normal from here. We're going to maybe come down, but I don't want to assume that. I want to be a little bit more conservative. So let's actually assume, for example, well, we'll get to that in a second, but we kind of get it that they have to grow at above 15%, right, to get there. Now, if we want a greater margin of safety, well, now we got to grow at 20%. Not so good. Okay, so I think that's where we can kind of finish it off here. You know, it's a short 15, 16-ish minute video, and I kind of covered all the bases. But my end conclusion is that while Disney is a fantastic business, and while I hope to have a showcase that again, nuance is so important when you analyze businesses, and each business will be different than another. But looking at Disney, fantastic business. I just got to get it at the right price. The right price is unfortunately lower. Doesn't mean it's impossible to get there. We did see it prior to pandemic even. We saw the prices around there. So if the prices do arrive, you know, in the $90-ish range, $80-ish range, even $70-ish range, I think that is a good price. If you own it and you already purchased at those prices, you know, there's not really a reason to sell necessarily right now. You own it at that really good, compelling price. And it's still from that price point that you bought, you still might perform very well. It's just for me as an investor coming in now, it doesn't make as much sense, right? Based on my requirements for an investment, okay? But on that note, I don't want anyone to think that I'm saying, you know, Disney's a bad company. No, it's a good company. It's a great company. Even though, and I hope, you know, you hope to see that everyone can see, I was kind of unbiased because I have a little bit of spite against Disney for, you know, doing what they did to my pastime, but you know, it's okay because they've liberated me from that pastime. I like to say to people, I kind of used to be a Star Wars fan. I'm not really a Star Wars fan anymore, just simply because certain movies are officially canon, and you know, a little bit of a rant there, but I know you guys totally asked for that information. You guys really wanted to know what Capital Mindset thinks about Star Wars, and in fact, the show is going to turn into a Star Wars show. I'm actually going to stop talking about stocks starting tomorrow, and we're going to be talking about Star Wars lore, beginning with the Old Republic. No, I'm kidding. I'm just kidding. I got to insert some comedy in here, guys. Okay. I got to insert some comedy in here. Okay, so I think on that note, we'll leave it off there. Oh, before I forget, because I know some of you guys like to see that, pull it up over here. There you go. You guys like that? You guys can pause there, and boom. We are done. All right. On that note, guys, I'll see you guys on the next one. Hope you guys enjoyed this long, I think it's Easter weekend, but I'll see you guys in the next one.